From New York City, I'm Lisa Abramowitz in for Jonathan Farrow. With 30 minutes dedicated to fixed income, the best market out there, this is Bloomberg Real Yield. Coming up, what will be the pin that pops this frothy bond market? Perhaps it'll be the central banks as the ECB firms up its plans to taper. Leverage levels are creeping up all over as the IMF focusing on the risk to financial stability. And as the largest U.S. banks report earnings, they're revealing a less creditworthy American consumer. How big of a concern is that for debt markets? We start with the big issue. Markets continue to shrug off risk.
It's really surprising when you look at all the events that have gone on and the markets become just so jaded to it, they don't react to it like they used to.
I don't know about you, but I'm nervous. And it seems like when investors are nervous, they're prone to being spooked. And nothing seems to spook the market.
Central banks are, in a way, keeping the pedal too much on the gas. And we are sucking out volatility in a way that I don't think it's conducive to long-term growth.
In this case, I don't see it's a really overwhelming bubble. I just think that there's a disaster risk that the markets are not taking into account.
So lots of existential angst, not a lot of action. Joining me around the table in New York is Michael Cloherty, head of U.S. interest rate strategy at RBC Capital Markets, Bonnie Wongtrakool, portfolio manager at Western Asset Management, and Scott Kimball, portfolio manager at BMO TCH Core Plus Bond Fund. I want to start with the ECB, since we did get some news overnight, giving more details about what their tapering plan might look like next year as they pare back their monthly purchases. And I'm struck by the fact that the market rallied. People bought bonds on the idea of them buying fewer bonds. Can you explain this?
Well, sure. The consensus going into last night, previous to the news, was that the ECB would probably finish tapering somewhere around the second half of next year. So what's been talked about now is a little bit beyond that. So I think that's why you saw bonds rally. And we're not surprised by that. We actually came into the year feeling constructive on the EU. We actually went long the euro. We felt that it was underpriced. And now we've seen the EU recover quite well. The growth has been pretty good. Inflation is okay, still not at the target. But at this point, we actually think that growth is going to decelerate a little bit. We don't think it's going to reach the EU's forecast. We think growth could be even less than 1.5%. And so as a result of that, we think the ECB is going to have to remain in the market, actively buying and doing QE for longer than the market expects.
Okay, so if you see Europe decelerating, you see the European Central Bank continuing its bond purchase longer than is currently priced into the market. Michael, given that backdrop, nothing can cause U.S. Treasuries to sell off, right?
Yeah, I mean, that's the problem we've had, is that every time rates start to go up here, we look really cheap to other countries. We see big foreign buying. Foreign buying's picked up, and also the foreign buying has come much further out the curve than it used to. You know, a lot of foreign private investors used to buy 2-year to 5-year treasuries, are out there buying 10-year and longer treasuries, so it has a much more powerful depressing effect on our yields. To get a really big move in the market, what we really need is inflation to pick up a little bit, for 2 reasons. One is the obvious: my cash flow is worth less if inflation's up. 2 is that the last few years, every time we've seen all these people piling into risk assets in order to reach a yield target. It's the, I can't afford to keep my house off of buying a treasury yield. That's not going to generate enough cash flow to keep my house, so I have to pile into risk assets, take a little more risk to hit my yield bogey. When rates start to rise, people start to pull out of those risk assets and they can hit their yield bogey in a safer way. So what we see is every time it looks like rates are going to take off, we see some jitters in the equity market, we see some jitters in corporate bond market. And then the Fed suddenly says, ooh, wait a minute, let me back off a little bit. They get much more dovish, and we rally right back to where we were. That will continue to happen as long as inflation is low. What happens if we start to see inflation pick up, all of a sudden the Fed can't have that put there for these risk assets, and then you have the potential to jump to much higher yields.
Real quick, do you think that that actually is plausible, that we're going to see that inflation?
Not soon. I mean, I think we'll see, a little higher than we got today, a little higher than the recent run rate, but not a dramatic jump.
All right, so Scott, given that, are you piling into 30-year bonds?
So, you know, the way we've positioned the Core Plus Bond Fund has been to sort of take advantage of what my colleague was talking about, which is that as interest rates rise, we're starting to see some trepidation of people that have owned those risk assets to maybe rotate back into more traditional asset allocation tools like, you know, core fixed income. And part of that is owning longer dated securities. We found a lot of value in owning 7, 10, and 30-year corporate debt, particularly in sectors that might get a little beat up on the headline news side of things. It's an opportunity to come in and buy some yield. So yes, we have been terming out a bit and bringing our portfolio duration back more towards neutral, with the expectation that the upside case for rates is continuing to dwindle with lower inflation. You know, I'm struck by the fact that we're not seeing that much inflation. We're not seeing that much growth. People are piling into risky stuff. People are starting to get nervous. The IMF talked a lot about financial stability. And then you have the yield curve, which continues to flatten, suggesting that growth is only going to slow down further in the future. At what point, Bonnie, does this make you very concerned about the financial stability that we're looking at if there is a downturn or an exogenous risk?
Well, I think the yield curve isn't necessarily by the flattening suggesting that we are going to have a greater chance of a recession. I think the reason the yield curve is flattening is in part what Mike was talking about. We still see a lot of demand for yield just because the level of yields absolute is kind of low, so people have to go out the curve. But I also think you see the curve flattening because we are seeing a little more inflation. You know, there's a little bit more chance of the Fed having to hike and going ahead with their normalization. So that's why you're seeing the yield curve flatten.
So you think people are misinterpreting it?
Well, it's not inverted, so I don't know how many people really believe the flattening is portending a recession.
Well, Michael, do you think that the curve could invert in the near term?
No. You know, if the Fed starts to tighten more aggressively, we think the curve is going to steepen a little bit going forward. To steepen relative to the forwards. The forwards have us flattening a lot more. We think it'll stay steep to that. To get you know, perfectly flat, we'd really need to have an imminent recession. If you look at consumer balance sheets right now, they're extraordinarily strong. Consumer spending should hold up even if we have little shocks to it. I mean, today we saw a solid report on the consumer side. So with that, it's the biggest piece of GDP. You have decent growth going forward. Yeah, no recession soon.
And Scott, you would agree?
We would agree. You know, when we look at the underpinnings of what's going on with the yield curve, it sort of is emblematic of this disagreement we think that the investor community has had with the Fed. They've been using the word transitory to describe this lack of inflation since about 2013. And I think that the market is sort of interpreting that, particularly some of the comments that came out from Fed governors, you know, earlier in the week about that particular word. There's a bit of a wrangling that's going on with exactly how much longer we're willing to wait before the word transitory is removed and the word structural comes in. So we think the flattening of the curve reflects the market foretelling to the Fed that there is certainly some structural underpinnings you need to start acknowledging. But at the same time, economically, GDP in the U.S., 70% of consumer spending, it's been very strong, and we think that there is probably an upside case to be made for inflation to accelerate in the next 12 months.
Bonnie, who matters more, the ECB or the Fed at this point?
I think when you're talking about quantitative easing, it probably is the ECB because the Fed has already communicated what they're going to do with the balance sheet. They've been very transparent about it. We know it's going to be very gradual, so there's not a lot of room around there to have movement, I think.
And Michael, how many hikes do you think we're going to see from the Fed next year?
I think we're going to actually get sort of a quarterly pace going forward. I think we're going to see 3 or 4 next year because, again, this solid growth backdrop. The Fed's still easy, even though, you know, inflation is below where they'd like it to be. That's the norm. You know, inflation's only above 2% about a quarter of the time going back 25 years. So you still need to take some insurance out, kind of keep moving back towards a more normal policy rate rather than if you wait until you see inflation, it's too late because then you have to be much more aggressive in order to catch up and you cause much more damage with that rapid tightening, particularly because everybody's piled into more risk.
Right.
This is the problem. Markets seem less liquid than they used to be. People have more risk on than they used to because of the lack of volatility. If the Fed does something and goes hard, they're much more likely to break the system.
All right, well, we're going to talk about that inflation dance and more. Everyone is sticking with us. Michael Cloherty from RBC Capital Markets, Bonnie Wongtrakool from Western Asset Management, and Scott Kimball from the BMO TCH Core Plus Bond Fund. Coming up, the auction block. Walmart sells bonds to refinance debt as it battles against Amazon. This is Bloomberg Real Yield. Abramowitz. This is Bloomberg Real Yield. I want to head to the auction block now. This week, the U.S. Treasury sold nearly $190 billion in bonds. We're going to focus in on the 30-year bond sale. It drew a yield of 2.87% with a bid-to-cover ratio of 2.53, the highest level since September 2015. On the corporate side, Walmart sold bonds to refinance debt. The world's largest retailer issued $6 billion of unsecured bonds in 6 parts, with the longest portion, a 30-year security, yielding 75 basis points. And junk-rated companies have raised almost $14 billion in the U.S. bond market so far this month. The second half of October typically sees an acceleration in issuance, making it very likely that the month will hit a 5-year peak for sales. Still with us, Michael Cloherty from RBC Capital Markets, Bonnie Wongtrakool from Western Asset Management, and Scott Kimball from the BMO TCH Core Plus Bond Fund. I am struck by what you all are saying to me and what we hear again and again. We just don't see the risk. People will continue to buy bonds. We saw yet another inflow that was the biggest weekly inflow over the past week since 2015. It makes me wonder, why not lever up? Why not just get as much leverage as you possibly can and pour your money into absolutely anything risky you can find? Michael?
Sadly, I think we've seen a few people doing that, and unfortunately it's the people under the most stress that have to do this. It's your retirees, again, that need some income. It's other people like that who are least able to sustain the loss, some pension funds, some other folks like that, some small banks.
Are you saying that you're seeing pension funds levering up substantially?
Well, taking more risk than they would have before.
In which markets in particular?
Really, spread product. So it's really corporates, structured products, things like that. So, you're forced to chase yield because you have to meet some target. You have to pay out retirees. You have to meet some earnings target. Can't do that buying treasuries, so you're forced to slide out the scale.
Scott, have you been more willing to use leverage given the backdrop that we're looking at?
So what's interesting is that for our Core Plus Bond Fund doesn't really use leverage as a tool. What we do is move around between 80% mix of investment grade securities with an opportunity to do up to 20% and below investment grade. We've sort of been on the opposite of the trade that you've outlined, which is that we're more willing to move a little further out the yield curve in investment grade to capture yield, as opposed to trying to stay low on duration and buy high yield at a really, really low high yield premium. So effectively, our viewpoint there is that we think there's better opportunities ahead to look at some of these risk assets. And right now, we're more on the investment grade side of things.
Bonnie?
And I'd say similarly, we also don't use leverage in our core or core plus funds. But in terms of valuations, although we think the fundamentals are very good, we think the valuations are relatively full, particularly for credit. And so what we have done is cycled out of some of that and been very selective about where we have those holdings and move them into other markets that we think have more value, like emerging markets.
So I want to pick up on the emerging markets point in a minute, but I just want to ask both Scott and Bonnie, do you see other investors engaging in behaviors that concern you as far as how much leverage they're taking on? In other words, borrowing short term in order to invest longer term, as well as going out the risk spectrum perhaps more than they would like to?
I think that this is sort of the corporate bond or credit bull market that is probably the most hated in history, in that people have been trying to predict its demise since the day it started. So, very candidly, when we look back at our own expectations for credit risk and credit returns, they continue to surprise to the upside. So at this point, we don't think the risk premium is high enough to own super subordinated structures and take on too much risk, particularly borrowing to further your risk out the curve. But at the same time, there are a lot of investors that are engaged in that, and that is one of the concerns that we have about when this credit cycle ends. When the cushion pops, it may be a bit more pronounced than is being priced in today.
And we have seen some investors, in this search for yield, as spreads have compressed in certain sectors, moving their allocations to other sectors. But I wouldn't characterize it as over-levering, I think.
Well, I'm struck by the lack of assets. I mean, people talk about the amount of cash. I think the flip side to that is that there aren't enough bonds for some people to buy, and you're starting to see synthetics come back. Synthetic CDOs have kind of come back, and you've started to see people kind of creating contracts to go around risky bank bonds in Europe. And I'm just wondering, I mean, is this natural? Is this still just small potato stuff in the corners, or is this becoming a more prevalent issue as people search for something to buy?
Again, is it a systemic risk? No. I mean, we're not anywhere close to that amount of outstandings yet. But you know, you're just seeing steps like this through this. We've seen a little bit looser language on some corporate bonds, you know, less security in there. Lots of things. As people stretch for yield, they have to give up something. And so you're seeing a little bit of a slide there. Overall, I mean, the economic backdrop still looks bright enough that you're not expecting a massive wave of defaults coming in that you get in a recession that would really hurt corporates. What worries me most about corporates has been this huge move towards passive investing. If we get a surprise default from somebody, you know, our fellow panelists, they know how to handle that. They know how to value that security. They can work their way out of that. Where some of the passive folks, it dropped out of my index, I sell it, I move on. As that passive thing gets bigger and bigger and bigger, the risks of a surprise default, you know, WorldCom was before your days, but something like that, if we get that, that's going to be much messier next time.
And Bonnie, quickly, you said that you're going into more investment grade than high yield debt. Investment grade is also pretty highly valued. Why do you think there's better value there?
We are going into more emerging markets.
Emerging markets than high yields. You were saying, Scott, that you're going more into investment grade, right?
Right. So effectively in the investment grade market, we are continuing to see very strong flows. And I also have to echo Michael's sentiments on the commentary about passive versus active. So obviously Core Plus is an active fund, and we do measure credit risk on an individual security basis, whereas passive and index, you don't do that.
Yeah. Well, everyone is going to be sticking with us, and we're going to delve more into emerging markets. Michael Cloherty from RBC Capital Markets, Bonnie Wongtrakool from Western Asset Management, and Scott Kimball from the BMO TCH Core Plus Bond Fund. Let's get a market check on where bonds have been this week. 2s, 10s, 30s, all getting tighter. People piling into bonds, cannot get enough of them. Still ahead, the final spread. The week ahead features the 19th Chinese Communist Party Congress, the country's most important political event that only occurs twice a decade. This is Bloomberg Real Yield. I'm Lisa Abramowitz. This is Bloomberg Real Yield. Time for the final spread coming up over the next week. Fed Chair Janet Yellen takes part in the Group of 30 International Banking Seminar. Catalonia faces a deadline regarding its independence. Greek Prime Minister Alexis Tsipras visits the White House. Morgan Stanley and Goldman Sachs report earnings. And China holds its 19th Communist Party Congress, the country's most important political event. Still with us, Michael Cloherty from RBC Capital Markets, Bonnie Wongtrakool from Western Asset Management, Scott Kimball from the BMO TCH Core Plus Bond Fund. I want to talk more, Bonnie, about what you were talking about with respect to shifting away from high yield credit in the U.S. and moving more to emerging markets. How are you doing that? Because I've noticed that recently an increasing number of firms have been piling more money into local currency, emerging markets debt, and away from dollar-denominated emerging markets debt. Is that what you're doing as well? So
emerging markets, we did start to move into that earlier at the beginning of the year when we felt that that was a good value. And since then, spreads have compressed a lot, particularly on the dollar-denominated debt. So at this point, local currency bonds do seem relatively more attractive, and we do have a decent allocation to that as well. So I would say that, you know, others are falling on that, but we think it has more room to go. If you look at the differential in real yields between developed economies and emerging market economies, it's at a 10-year wide. So we think that that still holds value.
Scott, are you also shifting more of your portfolio into emerging markets debt?
So we haven't really shifted our Core Plus strategies around into EM as a greater allocation, but we are emphasizing looking for opportunities, particularly in EM corporates, where you do earn a yield premium for the fact that the company is domiciled in an emerging market.
Michael, how concerned are you that this is a leveraged dollar bet, that basically as the dollar weakens, emerging markets look better and better, that as soon as the dollar strengthens, people get a rude awakening?
Right, and that's so some of this bet is, do you think the Fed's going to tighten really hard and fast or not? If you think you're going to get a really aggressive tightening here, that bet's probably not going to work out too well. I think unlikely that we get a really aggressive Fed. That said, We've had this gap between what the market has been pricing and what the Fed's been saying in its dots. With some of the new Fed chair potential candidates coming in, you probably see a narrowing of that gap. People, I don't think that you'll see wild actual differences in policy by the different Fed potential chairs, but we will see a change in how the market reacts.
Bonnie, are there any countries that you're avoiding?
Well, we were definitely very selective. I think, to Mike's point, emerging markets is a market, it's not a monolith. So you need to have an active manager to go through that. You don't want to really have passive exposure because different countries have different risks. There's going to be geopolitical risk across the entire world, let alone emerging markets. But in terms of credits that we do like, we do like Argentina and Brazil. We also like India and Indonesia. And some of that is, based on their risks to China, for example. So we're confident that China can kind of continue to decelerate growth, but we're also cognizant like a little misstep can really rock the market. So I think you need to be cognizant of that and navigate accordingly.
Well, this is the period in the program where we're going to do rapid fire, and you guys are supposed to answer quickly. One-word answers. Number one, do you think it's likely we'll see a recession in the U.S. within the next 18 months? Michael?
No.
Bonnie? Scott?
No.
All right. What do you think is riskier right now over the next 6 months, U.S. Treasuries or emerging markets debt? Michael?
EM.
Bonnie?
Treasuries.
EM.
Interesting. And now, which is more prone for losses, German or U.S. government bonds? Michael?
U.S.
Bonnie?
U.S.
German.
German. Interesting. And what's more overvalued, U.S. investment grade bonds or U.S. high yield debt?
High yield.
High yield.
High yield.
All right. Thank you so much, Michael Cloherty from RBC Capital Markets, Bonnie Wongtrakool from Western Asset Management, and Scott Kimball from the BMO TCH Core Plus Bond Fund. From New York, that does it for us. We will see you next Friday at 12 New York time, 5 p.m. London. Jonathan Farrell will be back in the seat. This is Bloomberg Real Yield.